Hey, I'm Mike Kerbin, co-founder and executive chairman of Vita Coco, and you're watching Taking Stock.
A big intraday reversal across the major market indexes effectively sets the stage not just for this trading Monday, but somehow and possibly already the beginning of the fourth trading week of the month of September. One and all, welcome to the show. This is Taking Stock. I'm your host here this afternoon, JD Durkin. We are live here on the iconic trading floor of the one, the only New York Stock Exchange, just moments away from the ringing of the equally iconic closing bell. If you look at the tail of the tape here for the day, my friends, the minute-by-minute chart, you can see the exact moment that the major market indexes turned from negative territory into positive territory. It came about from that huge news with regards to that new partnership from OpenAI and NVIDIA. As those big tech stocks go, so too go the broader markets. And that reversal really sets the stage for yet another history-making day. We are expecting all-time highs into the close for the S&P 500, the New York Stock Exchange Index, the NASDAQ Composite, as well as the Dow 30. Today on the show, Joe Cavatoni of the World Gold Council. He's on deck, set to join us here in just a moment. Jay Jog, our old friend of Say Labs, will be here on the show. David Gardner, co-founder of The Motley Fool, will be joining us in just a bit. And of course, the latest from Scarlett Sieber at Money 2020. The government of Panama is here alongside the United Nations General Assembly's 80th session. And with that, time here for the iconic closing bell. The government of Panama here in Lower Manhattan to do the honors.
Great to see you.
And there you have it, folks. Another history-making day here on Wall Street, which had not been the expectation for a lot of market participants, maybe on this Monday morning. But with that big tech news helping to send shares of technology companies to a new all-time high, the rest, unfortunately, probably can't be said for the rest of the major market indexes, the other 10 of the 11 sectors in the S&P 500. But it does appear as if we do have another day of all-time highs for the S&P 500 as well as the Dow 30. But this time on the show, we're going to start with a little bit of a different focus. Let's talk gold and precious metals with the man himself, Joe Cavatoni, an old pal of mine. He is market strategist and principal CEO of funds at World Gold Council. Welcome back to the exchange. Good to have you.
It's great to be here. Thanks for having me.
You good to hold the mic
I
while
am
you and
very
I
good.
chat? Okay, so I took a look at gold futures a few hours ago, right as you and I were coming out here. 37.80. It's up more than 40% year to date. What are you
That's
seeing
right.
in the broader price action across gold these days, Joe?
So we've seen 37 record prices for gold this year, and it's being driven principally by demand, which is outpacing supply, coming from investors. Investors are looking at risk, taking risk, but offsetting that risk with the right kind of asset, and that's where gold plays a part in their portfolio. Protects them on the downside while giving them that upside opportunity to grow.
What component about the way that gold has traded here in 2025, what part of that narrative, that story, Joe, do you think we're not talking enough about or might be prone to a bit of misconception out there?
The fundamental shift in how the economy is developing and how the world is looking at the dollar reserves, dollar-based assets, what's happening with central bank demand, and now investors finding a way to diversify and use gold in that portfolio.
And how much of that current rally do you think is driven by central bank demand? Is it more private investors? A bit of a combination of all the above?
It's a bit of a combination, but it ebbs and flows. Earlier in the year, we saw central banks driving a lot of the demand. It slowed somewhat. They have a little bit more of a price sensitivity to the asset and need to adjust their policies to reflect that. Right now, what we're really seeing, Western investors, ETF demand in the US, for example, up nearly 30 billion year to date in terms of inflows into the product. And they've had people talking about how that's been a waning asset base. But right now, it's all on for gold, and Western investors are saying, I understand risk, and I'm looking at preserving my purchasing power, and I'm looking at how I can diversify. And that key component is diversification, the right kind of diversification with gold.
Joe, without a doubt, you got a lot of retail investors. Some of them may be watching this interview live at the New York Stock Exchange saying, gold's the one thing, I see it a lot in the headlines, I don't really have the context, I'd like to add that to my portfolio. What do you tell someone who wants to become a smarter investor in the world of gold? Where should that person start?
The easiest way to get started, two ways. One, you can either buy it in physical form, and there are plenty of firms that can actually sell it to you. Second, you can buy a regulated financial instrument, exchange-traded funds that are physically backed by gold, not levered or inverse. The ones that have gold as their holding will track effectively. So you have two easy ways to get involved. One involves a little more understanding about storage, but when you want to just get that price performance, feel comfortable going with the exchange-traded funds.
Yeah, you talk about central bank demand. Let's talk a little bit about the Fed. We follow a very data-dependent Fed. Inflation prints, information that the Fed takes in. What are some of those make and break pieces of data that you look for specifically through the lens of gold?
Probably the biggest key event that's going to take place for us for the next 6 months is continued action with the Fed. Right now they've just cut rates, making holding gold more appealing and actually signaling to the world that the economy is on an interesting point and actually maybe showing signs of some weakness. That could be showing up in dollar weakness, it could be showing up in asset performance and risk assets. So right now we saw the 25 basis point cut. Two Fed governors are out saying we don't think there's a need for any more. Let's see how it develops over the next 6 months. But right now, all signals are gold continues to have a strong tailwind and continues to be a rising asset.
What would you want investors to know about the relationship between the way that gold trades and Bitcoin trades?
One's a risk asset, that's Bitcoin. The other is a diversifier that works in your portfolio, that's gold.
Geopolitical risk on gold, what are you looking for in terms of potential catalysts? Could be things we're not even yet talking about in the months ahead.
I think that's actually a really interesting question, one that's really difficult for us to predict, which is why we talk to people about holding on to your gold strategically, because you just don't know what's next. Political risks, the independence of the Fed as an example, different policy issues, these are all developing as we speak, but the geopolitical tensions, trade relationships, they ebb and flow. So hold on to your strategic allocation to gold.
Joe Cavatoni is a market strategist and principal CEO of funds at World Gold Council. Noel Palamine here from the New York Stock Exchange. What a golden way to start the broadcast. See what I did there, Joe? I'm sorry, I got all the dad jokes and ready to go. My man, thank you for being here. Howie, you and I are going to go take a walk. We will talk about some of these components here and a few New York Stock Exchange notable companies. Actually, today we're going to do something a little bit different. We'll first start with one retail consumer-facing stock. I want to talk about one of those State Street Select 11 sectors, one of the main sectors of the 11 in the S&P 500. Howie will pivot along this way. We're going to start with a fan favorite, Nike. We're seeing shares up fractionally on the day, about 0.5%. This comes after analysts from RBC Capital boosting the year-end price target for Nike to $90. That's upside potential of about 15% and change. RBC says, look, be on the lookout for things like FIFA World Cup sponsorships that could be an additional boost to the stock. The company also announced a new Skims line earlier today. It is under pressure for the month of September, but we will have Nike earnings next week. Howie, we're now going to head over this way. We'll talk about the State Street Select Spider ETF for XLP. These are consumer staples. These are the bread and butter stocks that you would anticipate the American consumer to spend money on despite how the overall economy is doing. Its largest weighted stock is Walmart, which was up fractionally on the day, but names like Costco, Procter & Gamble, Coca-Cola, Philip Morris, you name it, they're all also highly weighted in this ETF. They unfortunately were down for the day, sending shares of XLP down more than 1%. President Donald Trump announced last week that the National Guard will deploy to the city of Memphis, Tennessee, calling it, in his words, a replica of the Guard deployment now in its second month in our nation's capital. And our very own Carla Babb, a Pentagon reporter, breaks it all down. Take a look.
Hey, JD. People here in D.C. have wide-ranging opinions about the National Guard deployment. Some say having 2,300 Guard troops walking around their city makes them feel safer. Others have called it authoritarian. About 60% of Americans polled have opposed it. But if this assignment is any indication of the imminent deployment in Memphis, we at Cheddar started wondering, how much will this cost the American taxpayer, and what can officials learn from this cost? The Pentagon has declined to provide us the cost of the deployment until it is completed, at a time still yet to be determined. So we are forced to use estimates. A former vice chief of the National Guard Bureau told Cheddar last month that a deployment of 2,000 Guard members would likely cost an estimated average of about $20 million per month. The director of studies at the Center for New American Security told CNN the estimated cost could be as much as $31 million per month. Some of the Guard members here have been told they will stay until at least November 30th. So based on these estimates, the cost to you, the American taxpayer, is between $75 million and $115 million. But get this, The Pentagon has now put out a contract bid request on SAM.gov to feed all of the deployed troops here until the end of January. If they stay 2 more months, the estimated cost rises to between $115 million and $177 million. I should note these costs do not include funding for the additional officers deployed to the city during the president's 30-day federal takeover of D.C. law enforcement, which has expired. Now, how does that cost of up to $177 million compare to the needs of the police force? The D.C. Metropolitan Police Department is short 800 officers. That's right, 800 officers. Based on the starting salary of a new officer, the capital city needs about $53 million to close that gap. The Guard has also been helping the National Park Service with beautification chores, from picking up trash to yard work. A National Park Service official tells Cheddar that the service lost between 130 to 180 employees this year, and the administration also froze park contracts, so the service lost manpower there as well. These cuts to the D.C. parks would have likely saved millions of dollars for American taxpayers, but the savings amount to a fraction of what the Guard deployment will end up costing over the course of multiple months. The numbers show that adding more Park Service employees and law enforcement officers to D.C. would cost the American taxpayer significantly less than deploying Guard soldiers here. Current and former officials have stressed to Cheddar that before the Guard deploys to Memphis, they hope the administration will take a look at the numbers to make sure it's not focusing on what they say are the right problems with the wrong tools. JD, back to you.
Let's do it, folks. Welcome back to the broadcast. Time now for the latest in the world of fintech, crypto, and AI-related headlines. A bit of a crypto sell-off across a lot of the major coins and crypto majors we track for you. Bitcoin falling in the session 2.7% and ETH down 7% as well. Next up, in more detail to a story I brought you at the top of the show, NVIDIA stock rising sharply on the day after announcing it will invest up to $100 billion in OpenAI in order to power the next generation of its AI models. The deal promises 10 gigawatts of compute capacity. And finally, Anthony Scaramucci and HiveMind Capital are backing AVAX One. It's a new crypto treasury company spun out of AgriForce. It's got plans to raise more than $500 million to buy AVAX tokens and tokenize traditional financial assets on the Avalanche blockchain. I almost got through the whole thing. It was the second to last word that tripped me up. That's what happens. All right, let's talk to our old friend Jay Jog, co-founder of Say Labs. Jay, welcome back to the show. It's great to have you here as always.
Yeah, thanks for having me, man.
So what made you realize that centralized systems really weren't the answer? Let's take a step back, and I always love asking about the founder's journey and how things came together. What did that look like for you, Jay?
Yeah, absolutely. So I used to work at Robinhood back in the day, and I saw the entire GameStop saga going on back in 2021. And there are a lot of things that happened with GameStop, but I think one of the core things that stood out to me was just the way that Robinhood needed to put up billions of dollars of collateral to be able to just process trades as part of the market. And that is remnants of an archaic financial system. Like, the financial system was built in the 1970s, the 1980s, and that is not the way it should exist in the future. We're in 2025 now, and even now it's still T+1 settlement. It still takes 24 hours for these trades to settle. And in an internet-native world, we cannot have these archaic financial systems. So I do believe moving forward, we're going to be having these decentralized, much more modern financial systems being used.
What do you see as being the biggest problems that Say Labs can uniquely address, those main pain points that no one else in the space really can?
Yeah, absolutely. So one thing that has become extremely clear to me is that the EVM, which is the Ethereum virtual machine, is the gold standard that all developers use. But the EVM is not very high performance. If you look at Ethereum, which is one of the main L1s that helped introduce the EVM to market, it only is able to process around 20 transactions per second. If you want to have something like NYSE or NASDAQ that's built on top of it, it's just not possible because they need tens of thousands of transactions per second that are being processed. So I think long term you need to have something like the EVM, except have it be extremely high performance. And that is exactly what Say as a blockchain is. It takes the best of both Ethereum and Solana, where you get the EVM and the developers, the mindshare that come with Ethereum, along with the speed and performance you see with chains like Solana.
Yeah, so it sounds to me like you envision it as a bit more of a collaboration with Ethereum, Solana, not so much competition, or is there a bit of both?
Oh, it's definitely more collaborative in nature. Whenever we're building and improving the EVM, that results in Ethereum benefiting from that as well. So definitely whatever we're doing is just benefiting the entire ecosystem and growing the pie. And now you're starting to see more and more chains adopt the standards that we're helping develop. For example, you're seeing chains like Robinhood, or companies like Robinhood launching their own blockchains that are going to result in a lot more users coming on-chain and taking advantage of this tooling that is being built out by everyone.
What is something that you think you and your team at Say Labs are cooking? I'm sure you're working on a lot you're not quite yet prepared to talk about publicly. I know that's always the case, but something that you're really excited about, a cool core product or feature of yours that you would want more of your users to know about or pay closer attention to?
Probably the biggest project launch we've had in the past year is called SAVI2, which is the first parallelized EVM. So it takes the idea of parallelization, which is a very core concept in computer science, and applies that to the Ethereum virtual machine that helps bring over 5,000 transactions per second. So compare that to 20 that you see with Ethereum, and it's a massive improvement. And that's why I say I started seeing the adoption that we have in the past year. At this point, we're over $500, $600 million of TVL, and it's just increasing month by month. So I think a lot of this traction is tied to the first parallelized EVM being in practice, there in practice.
Let me ask you like an honest question as a co-founder here. If I were to tell you that the scale of the success of the company would be where it is at the end of September 2025, is this in line with your original expectations, or any part of the growth and adoption that maybe even surprises you a bit?
This has blown away any initial expectations that we had. Like, we got started with this at the end of 2021, and kind of where we're at right now would have been beyond our wildest dreams. And we're chatting with our team back at the offsite last week, actually, and it's just incredible to see the kind of traction that we've been able to build out.
That's awesome. All right, before I let you go, anything else that most excites you about where the company is, and give us some sense about what Q4 2025 looks like for Say Labs?
Q4 is going to be focused on a lot of the same kind of problems as before. From Say Labs side, it's going to be continuing to scale the EVM. And one thing I'm really excited about going forward now is just institutional adoption. With the passage of the Genius Act and with the Clarity Act that's about to make its way through Congress, there's going to be a lot more opportunities for institutions to get involved in the crypto markets. So we're just going to start seeing more and more innovation happen as that capital kind of starts coming into the space.
The great Jay Jog of Say Labs. You're always welcome back, my friend, to help make the case. Thanks a lot for being here. Good to have you. We'll see you again soon. Folks, don't go anywhere. Much more Taking Stock live from the iconic trading floor of the New York Stock Exchange is coming up after this, including the latest on startups, raises, and rounds, and an interview with David Gardner. He's the co-founder of Motley Fool. More Taking Stock coming up after this. Let's do it, folks. Now the latest in the world of startups, raises, and rounds at this hour. First up, NVIDIA looking to pump $500 million into UK self-driving startup Wayve. You all know Wayve. This is part of a bigger £2 billion push to supercharge Britain's AI scene. See what we did there? We called it pounds because it's the UK. All right, staying in the UK, fintech startup Tide, which provides digital banking and accounting services for small businesses, has raised more than $120 million at a $1.5 billion valuation. And finally, early-stage climate VC Volo Earth just closing a $135 million fund. It is a 50% boost, believe it or not, from its first to back startups in clean energy, mobility, and green building. That's the latest you need to know. Speaking of green, look at this beautiful green book. We got the author join us right now. David Gardner is the co-founder of the one and only Motley Fool. It is a household favorite of all of us who cover and live and breathe the financial markets. We love the Motley Fool. We're big fans of yours as well. Thanks for being here.
Thank you, JD. It's a delight to be here, and I'm really excited about this.
So this is the book, Rule Breaker. First of all, what is a Rule Breaker stock? What is this all about?
A Rule Breaker company is going to be one of the top dogs and first movers in important emerging industries. So think about Netflix, Tesla, AOL back in the day, the companies that are really blazing new trails and creating new technologies. And so those are the companies that I stay focused on, that I have pattern recognition around, and I also have very low cost bases in NVIDIA and Amazon, for example. So those are rule breakers.
When you talk about pattern recognition, are we talking charts and technicals, more fundamental analysis?
The latter,
or a little
my
bit
friend.
Of everything?
We're talking about the latter. We're talking about the business. So at the Motley Fool, we're very business-focused investors. So I'm looking and wanting to see companies that are changing the world in ways that I really approve of. Think about what Tesla did with the electric car. It's just been a phenomenal. It's going to end up being a robotics company, but for now it's a car company, and that's a good example of a rule breaker. So we're really looking at the fundamentals of the companies. We're never really looking at charts, and we're going to be owning the stock much longer than most people probably watching this show, because we've owned Amazon for 30 years. So we just stay in it, JD, and we keep staying in it. That's the story.
How do you teach patience? In this environment, we got lots of shiny things, got a meme coin resurgence. There's lots of ways where maybe itchy investors can look and say, I think I can make a buck maybe a quicker way. But you're talking about fundamentals and long-term investing strategies. Buy and hold. How
Yes,
do you
it
teach
is.
that?
Yeah, I think the way to teach it is just demonstrate it. So what we've tried to do is we tried to do that through our services, the Motley Fool. When we put in a buy on NVIDIA on tax day of 2005, here we are 20 plus years later, we're just still sitting there. And the ability to compound your returns without being active, passively watching greatness shine, is basically what rule breaker investing does, and what I think that should be its own lesson. I think we shouldn't necessarily think in sports, the more active you are, the better the results you get. In investing, it's kind of the opposite.
When was that entrance point on NVIDIA?
It's 16 cents. It was April 15, 2005. Now,
Holy
it wasn't
cow.
16 cents then. It's actually split 120 for
Yes, it
one
has.
over the course of time. So it wasn't a penny stock, but it's now pennies at cost basis. Fun fact, my Amazon cost basis is also 16 cents, thanks to splits again. So, but you know, it's finding the great companies of our time, Apple, and Netflix, and just recognizing them for what they are, holding them through every bad drawdown. Remember Quickster for Netflix? Remember Amazon getting cut in half like 6 times over the last 30 years? I mean, these things will happen for great companies, and we're okay with that. As long as the company continues to execute, that's why it's all about fundamentals.
Is there a really important piece of data or reporting from these companies that you tend to focus on that you think investors might benefit from paying a bit more attention to when they're trying to evaluate their own determinants of entrances and exits for some of these names?
First of all, I love that you asked that, because there's a little bit of a debate, I realize, in Washington, D.C. about whether we would just report twice a year, not 4 times a year. Huge fan of 4 times a year. I think the more information, the better. Just because you're looking at the scoreboard, checking scoreboard 4 times a year, doesn't mean that you're changing your favorite team every time. So I'm a huge fan of more information, JD. And you know, overall, I just say that the numbers that we're looking for are usually top line growth. Bottom line might not be growthy at the start. Chances are that, you know, Amazon's not going to make money the first few years that it starts. It's a VC mentality that we take these companies. But yeah, we watch every one of the quarterly reports, and the balance sheet matters a lot to us. We want to have a lot of cash, no debt. I will also say, in closing on this one, that a lot of the valuation metrics people use are overrated. PE ratios, price to cash flow, these are all basically not looking at really important things like who is the CEO. There's no line for that in the financial statements. The brand of the company, Starbucks' brand, is not represented.
Sure.
And so people tend to think all the great companies are overvalued because they're not factoring in Elon Musk or Netflix's brand. So
For sure.
we're looking for the right side of the brain things a lot of the time that people don't.
The book is Rule Breaker, How to Pick the Best Stocks of the Future and Build Lasting Wealth. The author, David Gardner. The show, Taking Stock. Thanks a lot for being here.
Thank you, JD. I'm honored.
More Taking Stock coming up from the floor of the NYSE after this.
Welcome back. I'm Scarlett Sieber with Money 2020, and on this episode of Hindsight 2020, we're going really far back. Way back to 1869, September 24th. I'm not just wearing black because I love wearing black. It's Black Friday up in here. Not the type that you wake up, early that Friday morning and go get that flat screen. We're talking about the OG, the original Black Friday, the Wall Street Black Friday. The day two Wall Street schemers tried to hijack America's entire money supply. Meet Jay Gould, a ruthless robber baron who built a railroad and telegraph empire through market manipulation, backroom deals, and an uncanny ability to outsmart his rivals. And of course, you got his partner in crime, James Fisk, a flamboyant showman financier, part Wall Street schemer, and part Broadway man, whose scandals were as legendary as his stock manipulations. Together, they hatched a plan to corner the gold market. And yes, that is the most 1869 sentence there could be in existence. Corner that gold market and have a beer for breakfast because water cleanliness was not guaranteed. When I tell you guys, we're talking about 1869, the average life expectancy was around 40 years old. Can you believe that? No computers, no high-frequency trades, no Bloomberg terminals. If you wanted gold, you had to physically go to what they called the gold room on Wall Street, a trading pit where brokers shouted bids and waved slips of paper with the energy of an auctioneer on 15 cups of coffee. And I've had a few, so I can only imagine what that would feel like. Gold and Fisk quietly sent in agents, dozens of brokers working on their behalf to buy up as much gold as possible, driving up the price day after day after day. Why gold, you ask? Because at this point in the U.S., gold was this quasi-gold standard. Get the point, right? Paper greenbacks issued during the Civil War were still circulating, but gold was really the measure of value. By squeezing the gold supply, Gold and Fisk could make exports collapse, grain prices soar, and rake in massive profits as the economy as a whole bent to their will. And for a period of time, by the way, it did work. Gold spiked from about $130 to nearly $160 an ounce in just days. Farmers couldn't ship crops, business people froze, and the entire economy teetered on chaos. Also, two of the wealthiest could become even wealthier. Sense a pattern here? I don't know. But the president stepped in. On September 24th, the Treasury dumped $4 million in gold back in the market. Prices collapsed instantly. Gold managed to flip and slip out with some profit. Fisk laughed it off. Everyone else, they were wiped out, destroyed. Fortunes destroyed, banks reeling, farmers furious. Black Friday revealed just how fragile the financial system was. But unlike the 1929 crash, which eventually produced the SEC and modern security laws, Black Friday didn't really trigger an immediate regulation because the U.S. in 1869 didn't have a mature financial regulatory framework. When you think back to this time, you think about your hindsight is now 2020, and you will have something to contribute to the inevitable Black Friday conversation that will be happening at the Thanksgiving table this year. So you're welcome. Bring in Gold and Fisk for a fun time. That was a rough one to get through, and we are here, so back over to you.
That's going to do it, one and all. Thanks for watching the show. Thank you to Howie on camera. We'll see you tomorrow for a whole new edition of Taking Stock at 4 p.m. from the NYSE.